What's up, Ian? What's going on?
What's up? Finally got used to that thing cutting off. I was waiting the whole time.
Yeah. That's our little intro that we've had. So welcome everybody to REI Madness. Hopefully everybody as excited as Ian and I are to chat with the team lenders today. I know the term lenders might be a little bit vague for everybody, but we have a hard money lender and we have two creative local bank lenders on this panel as well. So we're going to dive into some funding, some financing, lending, maybe some leverage as well on some single family property, short-term and long-term. We'll jump into maybe some lending for some multifamilies and some commercials. So no matter who you are, we're going to talk financing, we're going to talk funding, and I promise you're going to get a lot of value from this. Obviously, it's always nice to hear from a different range of funding sources, since everyone obviously has their own different appetite. Different banks, different private lenders, different hard money lenders, different funding sources always kind of focus on different things. So all the good real estate investors that I think Ian and I personally know, they use all types of funding and all types of financing sources depending on their deals. So I guess it's also good to note that all of these guys are local. So, if anyone's most of you guys are going to be in this local market, so you'll be able to potentially, utilize these guys after the fact for any of your upcoming deals. And again, this is a hot topic. Right now, I think if you don't already know, there is a lot of liquidity in the real estate investment space, but at the same time, you got to make sure you are leveraging up kind of with the right firm, the right lender to make sure you can execute on your project. So these things have to move quick. So you got to make sure you have kind of the right financing, not only short term, but also long term in place. So again, super thankful that Scott, Chris, and Redmond are going to be here with us today. And we'll introduce them here in one second.
Yeah, man, it's definitely an exciting topic. Some people might think this is the least sexy topic. We were just talking about this before we were bringing everyone on. But you need to understand the leverage of your money and leverage of capital, and when you're in growth stage versus stabilization mode. But before we bring the guys on, as always, we've had our sponsors throughout this whole event. This is a totally free event. If you found any value in this whole time, go over to reimadness.com. We're raising funds for the Metro Burn Foundation, the Breeding Group, Storage Rebellion, and Studio A Staging. Thank you so much for your guys' donations and everybody else that's donated during this time. So we'll send out some follow-up stuff on that and be doing a check presentation here in the next week or so. But let's jump right into it. I'm going to do my best to make sure the hard money bankers guys don't team up on the banker guys, but let's bring them in and get this ball rolling. We'll do some rearranging here. There you go. Move us to the bottom, move the boys to the top. And we got Redmond, Chris, and Scott. Welcome. If you guys just want to start, Redmond, you're on the left-hand side. If you want to go ahead first, introduce yourself, and we'll go right across the board.
Of course. Well, first of all, thanks for the invite, guys. Pleasure to be here. Good to be on here with some other lenders as well. Different options out there for everybody. But I'm Redmond Beam. I work for Shore United Bank. It's a bank that's about $1.5 billion in size. We're headquartered in Easton, and I am sitting in Baltimore. So I cover all of Baltimore metro market entirety. And I'm glad to be here, and hopefully I'll get to chat with a couple of you.
Sounds awesome. Chris, how about yourself?
Hey, everyone. Thanks for being on this morning. Chris Haddon, Jason Balin's business partner at Hard Money Bankers. We started HMB back in 2007, quite a while now, and we've seen a couple market ups and downs. So it's been a very interesting run. So we're a private lender for real estate investors, both investment residential and small commercial. So a lot of our clients are flippers, residential flippers, rental property owners, and then small commercial owners or developers as well. So yeah, thanks for having me on and looking forward to it.
Yeah, man. And Scott, you've been a supporter of ours since the beginning, since we were doing stuff at Nottingham's together. You want to introduce yourself?
Yeah, good morning. And first of all, I'm going to echo what Red said. Thanks for having me on. It's an honor, and it's great to be on with Chris and Jason. And a shout out to those guys. As I was thinking about this, they're like the pioneers almost in the hard money. They started, I think their story is at the worst time ever when the company started in the last mortgage collapse. 10, 12 years ago, whatever that was. So here they are now thriving. So that's kind of cool just to see that story and be on with you guys. And Red's a very well respected out there in the marketplace and what he does. And we've actually, shared some leads back and forth. So I'm appreciative of that, and that'll continue. But I'm Scott Freitag. I'm with Eastern Savings Bank. We're much smaller than Red's Bank. We're, I think, 350 million in total assets. Bank's been around a long time, and currently our focus is a lot of, residential investors. We do some multifamily and some other commercial projects, but we're okay with first-time investors, and we're okay with, that very experienced guy.
Nice. Yeah, thanks, guys. Appreciate that. Let's dive into the first question. It's been the first question that we've actually asked all of these groups for all the different teams that have come on here live, because I think a lot of people are interested and a lot of people have different views on this. And none of us have a crystal ball, obviously, but curious your guys' thoughts about where the market's headed. Maybe not long term, just throughout 2021. What do you see happening kind of maybe into the spring? Maybe spring into summer, and then maybe even later in 2021. And we can start with Red on the left. And, maybe it involves what you see the rates doing or just the real estate market in general.
Yeah. So right now, I think that residential rental units are maybe one of the safest bets out there. Retail is getting a little tough. Obviously, we all know that's happening in COVID. But I think that the rates are kind of going to stay right around the same place that they are now, depending on term, obviously, amortization, et cetera. But right now, I think residential rentals, multifamily, all of that stuff is hot. And I think COVID's only helping it, to be honest. So it's one of those things that I'd stick with.
Right. And how's your, I guess we'll go into Chris. What are you guys seeing in the marketplace, and how are you guys handling your business in 2021 with what happened in 2020?
Yeah, it's a very interesting question, and we've been wrong about this, and maybe that's just part of our conservative nature, but we've been looking for a market to cool, mainly the residential real estate market to cool for years now. And it hasn't really happened, like maybe a period here and there, a quarter here and there. And you would think that during a pandemic like 2020, that would have had a different effect on the residential real estate market. And it was quite the opposite. So it's going to be, there's going to be some things that happen during 2021. Rates are probably going up, maybe not right now, but later on in the year, both short-term and long-term rates in all likelihood, which will have a cooling effect on the residential market. Also, it'll be interesting to see how the stock market affects our niche. In all likelihood, that's going to, it's been riding the top for a while. That's probably looking at some kind of dip too. I think that the residential market in particular will stay pretty strong. I don't think we're going to see any kind of pop, but it can't go too much higher, right? It can't keep getting too much hotter. So I would say maybe pretty steady throughout the year to possibly a little bit of cooling.
Right. Yeah, no, I think we've all talked about it as like the top. We all feel like the weatherman. We keep saying it. Eventually we'll be right, but who knows? Scott, what are you seeing from your end in the 2021 market, and how's your bank handling it?
Yeah. So, COVID, is it's the talk of everything, right? It's everything we discuss, COVID, whether it's sports, real estate, schools, all that stuff. But the residential and multifamily markets locally and nationally have done extremely well. Reports from most are, most people are getting their rents paid. I think we're in some of the same networking groups, and we see some of the posts where some people are, my tenant hasn't paid in 8, 10, 11 months, whatever. I'm sure there's some of that, but I think you would expect to hear more of that, and we're not. And to what Chris said, I think, we may see a cooling effect on some of that, but I think residential multifamily is going to remain strong because, right, retail, you've got the whole Amazon piece and stores being closed and, political things coming involved with that. And we all need a roof over our heads at the end of the day. So it's one of those things that it's, we'll have dips, but I think it's going to remain strong. And the other thing, when you do have a dip, it's just, some are going to exit, but the single family space, that's the entry point for most people. There's the next group of investors ready to come right into it. So, and I think rates, I think rates will remain stable. I'm hearing all the economists, Fannie Mae, Freddie Mac, are saying for the next 2 to 3 years. We don't know what's going to happen tomorrow, so I don't know about that time frame. But I think we're going to be in this range for, probably the rest of the year for sure.
Yeah, no, I think that makes sense. Let's talk a little bit about different financing facilities and how aggressive. Actually, let me bring Red back on real quick so he can hear. No, that's okay. So you can. I want to make sure you can jump in on this question as well. So let's talk a little bit about different financing programs and options and facilities, and maybe how aggressive you are now. Like, how does the LTV rate up to previous markets, maybe post-COVID, pre-COVID? And, we've talked to a lot of folks. We've had some residential and commercial investors on here. And, it seems like residential in general, there's a lot of liquidity on the marketplace, and everyone wants to be as aggressive as they can, lowest interest rates they can, to have as much market share as they can. And, that might not be the best recipe. But in the commercial space, it's what Ian and I were told a few days ago was owner-operated commercial buildings, all banks are really looking to jump on. But new office complexes, stuff that's vacant, stuff that's not stabilized, has been a little bit more challenging. So maybe if we start with just Red, of like, again, a lot of us have broad products, right? But in general, like, where did you think your bank fits in the most related to the types of facilities that you're offering, and how aggressive would you say you are, like LTV wise, compared to last year?
Yeah. So on the residential side, obviously we like the rental units. Hard money is very nice and attractive for the fix and flips, just because, ease of use, time wise, it makes it easier for you guys to do that stuff. Rental wise, though, we've been pretty strong. We like to group at least, a couple units together to make it worthwhile. Pricing goes down as loan amount goes up. And as far as LTV wise, et cetera, we usually look at somewhere in the 75% range or 90% of costs. So the bank does like to see that, you've left 10% equity in the deal. So that's kind of your skin in the game. But usually, as most people know, you can figure it out. So it works well for everybody. And I think that's a good angle that we're taking. But you are correct in stating the office buildings. I mean, owner occupied is hot right now. Everybody wants to do it. I also think industrial is very strong because it's, something that's just popping, and it doesn't really have any big issues at the moment. Also on the multifamily game, those are always good to have. The bigger, the better for us.
And your goal is more longer term types of projects. I mean, obviously not super long, but 5-year.
Yeah, 5-year, 10-year, 15-year. We also have swap products that we can get into with multifamily deals, or a portfolio of residential properties. So those rates are pretty attractive. So sub-4 rates for a 10-year term, 25-year AM. So it's pretty good.
Yeah.
All right, good. I hope your bosses are watching so I can renegotiate my terms. No, but yeah, and I think you'll see a little bit of difference between what Redmond does and Scott does here, and based on the size of the banks and what their appetites are for. But before we get to Scott, Chris, what recapturing Jason's question here, what are you guys up to?
Yes, we have a couple. I mean, we have one main program, I would say, if you can call it a program, I don't know, in the private lending world, but we lend up to 65% on a fix and flip. So based on the after repair value, that 65% would also apply if we're working on an as is value or a purchase price, loan to cost. So yeah, I mean, that's a good bulk of our business is the fix and flip, but we love the as is value bridge loans as well. And, double digit interest rates, like 13%-ish year term, obviously a shorter kind of time frame. Nobody wants to hold a double digit interest rate loan for too long. But we oftentimes, our clients, they typically have 2 or 3 or even 4 different ways to finance deals, right? They'll be working on credit lines. They'll get maybe a term loan from a bank. Private lenders, like maybe raising their own cash, hard money lenders like us. So it really just depends on what they're up to and what makes the most sense. But we've always been private capital. So we never went for, funding our own loans with credit lines or institutional money. Basically like we're a friends and family fund. So we move quickly. We service and control and underwrite all of our own deals. That's the way we've always wanted it. We invest in our own loans. That's a big part of our long-term plan as well. So yeah, we've always just wanted to be a local, mid-Atlantic, very quick, accommodating private lender.
Yeah, and as someone that's used everyone's product here, there's a need for your capital, which we'll get into in a second, and the relationship with the back-end banks. But I've seen Redmond and Scott pass you guys deals that just don't fit in their box. Scott, what's your loan product look like, and what are you seeing for 2021 on your loan product?
So we do a lot in the single family rental space, whether it's that one-off, the number one question I get, a lot of people always ask minimum loan amount. Look, we all want bigger deals. We all make more money, but I also get, some of these $50,000 loans, let's say. Usually what my experience is, those guarantors are usually pretty strong. Sometimes they're first timers, but they're always pretty strong. We'll do them. We also been seeing a lot of larger portfolios, 15, 20, 30 properties that we've closed out a couple of those large size deals at the end of last year. Leverage standpoint, we're kind of like exactly what Red said. We're kind of in that 75-ish range. We'll look at 80 and, kind of like 90% of LTC, loan to cost on like a refi situation. We have, one thing about the COVID, our LTVs, we haven't changed any, debt service coverages or lowered LTVs. And I know some of these Wall Street guys, that's kind of coming back more and more each day. But I know they did reduce, a lot of LTVs and things on the cash out. So,
yeah, let's talk a little bit about leverage because, I think a good lender, it could be a banker, it could be a hard money lender, it could be a private lender. You try to keep it a win-win for your client in order for, we all want to accommodate the borrower to make sure they perform. The last thing we don't want is not to have performance, even if it's a super low LTV deal. Like performance, we're lending money because like that's our business model, right? Like these aren't loan to own things. There's this common misconception that it's like, oh well, if I don't pay my bills, they'll just foreclose on the property and they'll make all the money on the deal. And it's like it doesn't work like that. We all want to make sure we're writing good loans to good people and they perform and they move on to the next one. So, but let's talk a little bit about leverage because in general, I don't want to say this across the board, but a lot of people want higher leverage, right? There's a lot of stuff related to using other people's money. What are your guys' stances related to gap funders or seller seconds or seller, take back financing or just something, something related to that? Like, is that allowed? Is it not allowed? Is it kind of case by case? And again, I don't necessarily state that of nobody has a dollar, like a borrower that doesn't have a dollar, so they need to put it all in. But there's a lot of investors out there, especially, I don't want to say newer investors, but investors that are in the growth phase, right? On the growth phase, they don't want to put up 30% of their own cash if they need to in every deal because they're limited by how many deals that they can do. So what are your, I don't want to say necessarily terms, but what are your opinions on the capital stack and potentially getting some sort of secondary funding behind yours?
I'll start it off. I think that leverage is a good thing. I mean, anything that can increase your potential return is a positive. However, it's definitely a case by case basis. For instance, if you have something and it's a lower LTV and you want to throw a second on there to, pick up some more properties, increase the rents somehow. I mean, I think that that's a positive thing for everybody, not only for the borrower, but for the bank too, because it's better loan at that point.
Yeah. Hey, Jason, I think you mentioned a really critical point leading up to this is that, they don't want to, it's not like they don't have any money, but they don't want to sink all their cash into a deal. And I think that's a critical point. I'm sure Red's bank is the same way. We're not going to fund 100% of the deal. Like, hey, you guys at Eastern or Shore United, you lend us 80% and the seller is going to hold 20%. I get those calls from time to time. We're not going to do that. But back to what you said, I closed a deal late last summer, early fall, smaller multifamily deal. And they approached us they already had it kind of in place that the seller was willing to hold a small, I believe it was 10% second. I'm like, oh yeah. And our borrower was putting 15% into the deal. So we're at our 75 LTV, and it's not like that was their last 15% they had. They had plenty of extra liquidity. We did that deal all day long. I mean, they're very strong, made sense. So I think it's a great thing if it's available, just as long as people don't understand, hey, don't come to us looking for that gap funder where it's like you have no skin in the game and it's going to be 100% CLTV.
Yeah, in our world, in the hard money world, were you going to say something on Scott's comment?
Ian's muted. That's a good. That's actually a good look for all of us. That's a good look for all of us. Ian, you just stay muted and start talking.
Yeah, make favors. Okay, so in the hard money world, like we know very well that our clients raise money. They have other kinds of financing. We oftentimes don't see it at the time of closing. There really isn't any subordinate financing behind ours, but there might be a second lien that pops up later or something. We might know about it, we might not. Really not an issue. We know it's part of the game, raising capital, using credit lines, whatever it may be. And it's not a problem for us. It's not a problem for us because we typically don't see it. And if we do, it's way later on, not much of an issue.
Yeah, and I can get what like Jason's saying, and I can see a difference between Brett and Scott versus what Chris and Jason do of making sure that there's borrower liquidity. And I know like when I go to you guys initially, I'm like, hey guys, I'm going to want to do this deal, and I know it fits in your box, but you're like, yeah, you still need a few dollars in the game. I'm like, I know, but we did this deal and it fits in your box, but really you're actually kind of protecting the borrower. You're giving them even more room and more fluff. God forbid something goes sideways, and then when it's time to go refinance, like we just did with Redmond recently, and we've utilized Scott's products, is that we don't need a 75 or 80% LTV. The refinance we just did in a very short period of time with increasing prices, but I think the initial money that we borrowed from you guys was able to help this. Is we only needed a 70% loan, and when you look at it over the long term, I think we're going to be in a way better spot 20 years from now, or even just 5 years from now, because you're starting at 70 rather than 80, and you're paying just a little bit less interest, and it's a lower balance, and there's a lot of things that go into that. And I think you guys bring up all good points.
And also, like, it's important to have a vested interest in these projects. And it is different on the front end versus the back end, right? On the front end, if these are short-term flips or short-term fix and then rents to a rental product on the back end, let's keep it easy. $100,000, the lender gives you $70,000 and you need 30, right? Like if you're not putting up that $30,000 and you're getting a seller or gap funder or something to put up that 30, you have zero vested interest in that thing. You have proposed sweat equity that you're going to put into that, but you haven't put into that. But that being said, with the longer term debt, for instance, let's say you buy it for 70, you put 30 into it of your own money, right? So you get leverage for 70, you get debt, or you get equity of your own money for 30,000, and then you're in there, you're grinding, you're putting sweat equity in. 6 months from now, it's a really nice renovated house. You throw a tenant in there, it spits off $1,400 a month. Then it could be appropriate to get a bank to give you a $100,000 loan. You pay off your 70 first, or your private lender, you pay off your 30 to yourself, and you have sweat equity. You don't have sweat equity in the front end. You have sweat equity after you're improving the product by doing that. And I think that's why, a lot of banks and a lot of lenders see it, because it's just like anything else. I mean, there's deals that we do, even if it's a really, really good deal, we want our clients to have some skin in the game because it's important. We want them to have some sort of vested interest to tie them to the deal, even if it's $100,000 on a $400,000 property. And I understand the notion of like, oh, well, you can just take back the property, they'd be losing so much. Well, they're losing sweat equity. They're not losing their perceived sweat equity. They're not losing their own funds in a situation like that. So I think the leverage I think more people should understand and be kind of on both sides of what people kind of what you see in it. And there's also the notion of, like we talked about earlier, other people's money. And I'm all about other people's money. It's a good way to potentially do it, but you might need a few different capital stacks in that, right? You might need a first lender, a first bank, then you might need a private lender, then you might need some of your own money, then you might need a HELOC. That's typically the right way to kind of structure some of these things.
Yeah, definitely. And just so everyone knows, it's a totally interactive show. If you guys have any questions, any comments, anything that you want us to cover in this, I know we're talking about some higher level stuff here. If you want us to go backwards or you want to talk about anything, just post the comments. We're on YouTube, LinkedIn, Facebook. And if we don't get to your questions now, the presenters are going to get on there and answer them afterwards. Yeah, let's do this. Let's bring up Nick's question before we get into the next topic. And what are the elements are you guys avoiding on lending on right now? Like rural, historic, rough neighborhoods, high rehab costs. If easier, what deals are perfect for your routine, which I think we kind of covered. But what is there anything that either the banks or hard money bankers is avoiding right now that the marketplace has zero appetite for, or a super low LTV?
Well, Nick covered most of them right there, so he answered a lot of the question for us. Yeah, so when we're talking about residential, specifically investment residential stuff, we definitely focus on the median housing price neighborhoods. So a lot of the suburbs around where we are, around DC, Baltimore, Philadelphia. We definitely do city properties. On occasion, we'll do something that's further out, but I mean, he's absolutely right when he hit all that stuff, rural, historic, rough neighborhood. I mean, there's certain places where the lending just doesn't work as well. And to be honest, and that's because the property investor, the investment, the buy in those areas doesn't work great either. It's too speculative. Like if you're talking about a big, awesome house in a subdivision compared to a big, awesome house way far from any subdivision, it's just way harder to predict how that deal is going to work out. So it makes it more difficult on the buyer side and also on the lender side as well. And then a little bit on high rehab costs. So that's, you learn over time how those jobs play out. And some people are perfectly set up to run, a $150,000 construction job in the residential world. And some folks just aren't there yet. They don't have that experience to execute that right. And you learn that from being in this business over time. So yeah, I mean, for the most part, it's stick to the good areas of cities, definitely the suburbs for sure, median housing price neighborhoods. And that's where, 95% of our portfolio is going to be.
Yeah, that makes a lot of sense. And Scott, I want to reframe the question a little bit for you, since you guys do a lot of single family stuff. What does it look like for new builds? Because we did have Team New Construction on here. We had Jimmy Harris talking about this. Is there anything that you guys are avoiding right now in the new construction or single family world?
Not really. I mean, we're looking at, people always, part of the question here is like, I brought up the smaller loan amounts, or I think this question says rough neighborhoods. That's relative. We'll take a look at any deal. We're not avoiding it. We're going to look at the whole picture, not just the property. We're going to look at what's the strength of the guarantor. I mean, are they experienced? Is it their first time? As Chris alluded to, bigger rehab project. What's their experience? Have they ever handled $150,000 rehab? All those elements kind of go into it from our aspect, but we're willing to look. I mean, we're looking at retail, smaller retail, strip centers at this point, if they make sense. And some of them do and some of them don't.
Yeah, that's real interesting, because we've been working with some other lenders out there, and the Gaslight Square, when I was talking to Redmond about it, is we got into the HCVRE or whatever the heck that was, and we wound up in a different class because office space isn't hot right now. And that's what I want to reframe the question to you, Red. I know you guys do some bigger deals, some more development speculative. Like I know you guys are doing something right down over there, Locust Point area, where they're tearing down that big building. What's your bank's appetite for is there anything that they're not, like, are they avoiding right now? Office space or major land development? Is there like, hey, if you call me, there's just like, I can't do this?
Yeah, so I wouldn't say that we're fully avoiding anything. However, the appetite's definitely changed on retail, some office buildings, just for the fact of, everybody started to work from home. I think that, companies are seeing that people can actually work from home and be efficient. And same thing, I mean, on the retail stuff, a lot of the retail stuff is, kind of going away. Everybody's moving over to not solely Amazon, but, those bigger boys where you can just order it and it's there the next day. So when we look at that stuff now, we're just looking at a little bit lower of an LTV. We obviously want to make sure that the property has a good occupancy rate, but there's nothing that we're really truly avoiding. So,
well, the only thing we got to do is get the bank to invest in some new internet for you. But hopefully everyone caught that. But something I wanted to highlight is that I think any one of these lenders here will do a deal if the LTV is right. And again, that goes back to having skin in the game. If you can make that deal that much better for the bankers, you're more likely to get a deal done.
Can you hear me?
Yeah. Yeah. And also, I think we all missed a big key word related to relationship. A relationship has a lot to do with it on these types of deals. It can be with a banker, it could be a private lender. However, a JV partner, I mean, that's typically how it is. I mean, these aren't deals that you're going to want to go to Bank of America or Wells Fargo or some of the big banks to do. Do they have a product for longer term stuff? Yeah, probably not fix and flip. But in general, you got to look at kind of everything kind of as a whole to see what makes the most sense to do on some. I remember a few years back, Ian said Hard Money Bankers, some deals in an area of the city that we had never lent in and didn't really want to lend in. And we decided to do it because of the relationship, right? We structured it based on the relationship. We looked at the risks of the deal versus the rewards of the deal, and it made sense. So I think a relationship has a lot to do with it, and anyone can make a relationship with, your banker, your private lender, just like anybody else. I mean, keep in mind, everyone, I know there's a notion of, banks don't want to lend. They don't want to do anything. Well, they want to lend to the right people. They want to lend on the right product. They want to lend in the right opportunity. Like that's how it is. I mean, it's a lender's responsibility to lend out their money or other capital, and it's their responsibility to get that capital back. So they're going to do whatever they can to prevent a default. That's just what it is. And related to like rural, historic, rough neighborhoods, high recap costs, we've lent in every one of those categories. Scott and Red have probably lent in every one of those categories. Do we focus on it? Probably not. I mean, a lot of times we're helping our clients without them even knowing. I mean, keep in mind, I don't know how many loans you guys have done. I'm just obviously a lot. Chris and I have done over 3,000 loans, right? So we've seen a lot of situations. I don't know many real estate investors that have done 3,000 transactions. So, not really like, this isn't like, a bragging comment, but like we have experience of what we've seen in the past work and what hasn't worked in these deals. And, in general, if you're in a rural area, and there's lots of rural areas in all the parts that we're in, Western Maryland, the Eastern Shore, Ian's house, they're all rural areas in general. So, and I recognize, and we've lent in every one of those markets on the right deal. If it's a rancher with no basement that sits on the side of the road, in the middle of nowhere, how can we really determine what the value of that property is? That makes it challenging. So I think to sum this up, if the deal makes sense, it could work. I mean, there's deals that we'll quote all the time that we'll say, hey, listen, like we're having a hard time wrapping our brain around this deal. We'll put up half, you put up half type of situation, right? So you're buying it for 100, we'll give you 50, you put up 50, because we want to help. We want to do what we can to make some of these deals work. Let's jump in. I had another question related to this, but let's jump into. Let me just go through some of these real quick. So Mike, Scott, you got a shout out from Mike.
How much that cost you?
So thanks, Mike. Appreciate that. Or to Scott. So this one came through one of our Facebook groups, so it doesn't display their name. Is anyone offering a flat 25 to 30-year loan on commercial or multi, or are we still at the 5, 10, 15-year loans on a 20-year AM schedule? And you guys can answer that. I don't know if either one of you guys are. I know that product does exist. I mean, there's a lot of like institutional backed lenders out there that, I don't know, they have Wall Street capital, they have secondary market capital that allows them to originate those products. Do either one of you guys have that now?
Go ahead, Red. Go ahead.
So we currently do not. Our longest term that we're doing is 15 years. However, there are a few swap products that you can use to give you a longer term. However, those have minimum dollar amounts. So it would most likely be a multifamily deal or a portfolio loan for those.
Yeah, we are not offering that fully fixed, 25 or 30 year. We'll do the 25 or 30 year AM, but it's going to typically be that 5, that 5 to 10 range.
Yeah. Okay. Yeah, and rightfully so. I mean, I understand it. And there's capital sources that are out there that are doing them. Obviously, they're typically a little bit higher interest rates. So you gotta see what works. I mean, as we've expanded into, because we actually have an amortized product at Hard Money Bankers, it's still a 13% interest rate, right? So it's hard to work on a lot of situations, but there's a lot of like owner-operated commercial buildings that utilize it because they might just not be bankable and they have a low LTV type of situation. But I like the short-term amortized as the lender, and I like it as potentially a borrower on some of these deals because, study an amortization schedule and see how it works. The coolest part of an amortization schedule is like stuff pays off quickly, and a lot of that money is going towards principal every month. So in a 30-year or a 40-year, I mean, it's not much more than interest only. But when you get into a 20 or 50 or 10, it's interesting. So let's jump into Vadim's question real quick. For long-term financing on smaller commercial properties, are there any red flags you guys look out for, or anything else you prefer to see?
When he says commercial properties, is he meaning mixed use or is it multifamily?
I would guess, just from knowing Vadim, probably real commercial, like probably
mixed use.
Yeah, maybe mixed use. So maybe we start with that and then multi after that, maybe.
Yeah, red flags, and I think you got to look at it more in specific context. But from the mixed use perspective, commercial tenants and leases are radically different than residential. So getting your arms around who that tenant is, what their business is, what the lease terms look like. For us, in my experience, that's usually the only. I don't know if I would define it as a red flag, but that's going to be questioned more than a typical what a pure residential situation would look like. So hopefully that answers Vadim's question. If not, he can throw it up and be more specific.
Yeah, I agree with what Scott you had to say there. I think lease terms are big right now. If it's something that ends in the next couple of years, obviously, at least on our side, we like to see it executed before our actual settlement for a couple more years. If we're doing, per se a 10-year term, we want it to, have a little more skin on there. But.
Yeah, that all makes sense. And with that being said, I guess we've been talking a lot about relationship and how we all work together, because obviously we've all worked together here on this one specifically, and I'm sure you all have worked with people on all the other interview panels. And Chris, I guess look to you is like, you're a newer investor, you want to buy a rental property, you need to fix it up, so you go to you guys, and then what does it look like? How do you guys view it from your end? And then do you guys help and say, here, I know Redmond and Scott, and pass it off? How does that relationship look all the way through the product? What do you look for up front when you're talking to a new borrower?
Yeah, sure. So I think it's important if it's going to be that situation where somebody's buying and holding, let's say for a residential investment property, single family, that they look into that permanent financing before the acquisition closes, right? So they know that they're going to have that exit. They talk to someone like Red or Scott, and if they're at the right LTV and credit score and cash flow and the stuff that they need to be, debt service coverage, that takeout loan is going to happen before they close on the acquisition. So it's really just underwriting throughout the whole thing. We can point people in the right direction there. We don't tell them exactly what to do. We can help out in any way. But Yeah, I mean, and that happens all the time. Like, not every one of our borrowers are flipping a property. A lot of them do hold it, and they might not. We do see situations where they don't do enough homework up front, and they get to the time where they want to pay off our loan, but then they're not sure. Like, are they going for like some 30-year Fannie product, which has some certain drawbacks? Are they going for a commercial type of loan like these guys do on a residential investment property? So I think it's really just important to do your homework on that takeout loan before the acquisition happens.
Right. And then how about for you, Scott? Like, what do you see? Like, say I have a hard money loan, I fix the property up. Can I get full LTV on that when I come over to you? Or like, what do you guys like to see in that transition period from someone utilizing someone like Hard Money Bankers to then getting into a stable loan product with you?
Got it. Yeah. So we talked about this up front. Normally, to get the full LTV, we like to see it stabilize for 12 months. Most of the time, people aren't waiting that long. They want to get out of the short-term, higher interest loan, and we'll go up typically like 90% loan to cost, which is purchase price plus their documented cost of renovation.
Right. And how about you, Redmond? Is it a similar thing where it's loan to cost versus the loan to value? And I guess maybe for those that don't know the difference, if you want to just explain how you guys view loan to cost versus loan to value.
Of course. So we usually do, like Scott was saying, 90% of cost. So that cost number is, your purchase price, your closing costs, and your value, and, cash that's actually being put into the deal, not, time of work in the deal, etc. But then from our LTV standard, we look at a 75% range. And what the bank does here is takes the lesser of the two. So say you've got a property that, comes in at $100,000, we give you $75,000 if that was less than your total cost in. So say your total cost is, I don't know, we'll do the same thing. Your total cost is 100, then, your ask would be, $90,000 out on it. However, since we're doing the lesser of, we give you the 75K.
Right. And I think something that's important going into this is that, like, knowing the back end, and it was always like a problem with us, like when we were trying to build our portfolio, is like we would easily get money from Chris and Jason, and we had our other resources to do a lot of deals, but then it was always like the backup, like, oh my God, how am I going to get out of these? And, we came up with guidance lines. We had a bunch of different things. And I'm going to go with you, Scott, first, and then probably to Chris, is like, I don't think a lot of people realize that you go to a deal committee and having like a presentation of who you are and what you're trying to do to ultimately to be able to get a better loan product. Do you want to explain how like the commercial banking world works, of like the deal committee and having to have a good presentation of how you expect to get your deals done from a borrower's point of view?
Sure. So a lot of the typical single family, the one-offs, as I'll refer to them as, we don't need to take that to loan committee. That's example Red was using, $75,000, $90,000 loan. That's all decided, from just a basic underwriter's standpoint. When you start getting into larger commercial deals, $500,000, $750,000, $2.5 million. Yeah, now you're talking, we define it as executive loan committee, and at certain points, full board approval. So fortunately for me, in a lot of the single family space, not every deal I'm having to get in front of the committee to present these deals. And when we do, obviously it's you got to have all your I's dotted and your T's crossed. And we take care of that up front as the lenders and, our chief credit officer, chief lending officer, to make sure when we're going to the board, we know we're pretty strong, confident we're getting an approval on that. Otherwise we wouldn't present it.
Right. And from a borrower's aspect, the more information I can present you, like it's Dan and Ian from Equity Warehouse, we're both city firefighters. We do this, we do that, yep. And this is how we are. That helps your case to potentially get a better loan product, right?
Well, it does. And I think one of the questions or topics that we had discussed here is, your slide deck sort of type thing. And I think for the newer investors and even some of the more experienced ones, most people don't do that. And it doesn't necessarily hurt them, but up front, when I know who they are, the who, what, when, where, and why sort of thing really helps us understand like the big picture, as opposed to just getting a call or an email like, oh, I got a rental, I need the refi, what's your rate? I mean, come on. I mean, it's like, I think we're talking about relationships. That's not how I would establish a relationship. So all the investors out there, kind of jot that down and take a note. You want to establish a relationship, put something together, tell us who you are, where you're at, what you're trying to accomplish. And to me, it's like, I get it, rate's important, but as a lender, and I think Chris and Red will say this, we want to know, how are we getting repaid? Like, you're just asking what the rate is. Well, does the property cash flow? You didn't tell me that. Now we got to dig in. So I know that was one of the topics we had discussed. So the better job they can do presenting that up front, it just starts off the whole process smoothly.
Yeah, and that's what I was going to ask Chris, is like how it almost kind of differs of like, Scott's looking for who you are and Redmond are looking for who you are long term. It's a longer term product, where you guys are short term. Like, what matters to you guys? Like, if I'm a borrower, I come to you and I'm like, hey, I got this property. What does that look like? Do you care about the exit strategy? Do you care more about the borrower? How can a borrower help pitch their case for a loan that they want to get from you?
Yeah, interestingly enough, there are a lot of similarities between a private lender and a bank lender, because we're looking at the same stuff for the most part. Like, we're looking at loan to value, right? We're looking at credit, we're looking at cash, we're looking at income,
all the same stuff. I mean, we can probably have more wiggle room and make more, like, for example, like some conventional or bank loan products, if you don't have X credit score, it doesn't matter if it's a 5 LTV, they can't do it in some case, right? And so, like, we can make more judgment calls in that regard. But also, interestingly, our loan committee, like informal quote unquote loan committee process, is also similar. So if we're quoting our normal, 60 LTV in the suburbs, 250K loan, like just a run of the mill deal, it could be Jason, it could be our business partners, Ian and Ryan and Josh, who are in Pennsylvania, New Jersey, and different regions that they run. And they're just going to quote the deal because it's just like any other deal. There doesn't need to be any more discussion. If it's something similar to what these guys said, a larger loan amount, maybe something outside the box, maybe a different kind of scenario in general, then we will have sort of an informal committee where we'll talk about it. Jason and I will discuss it on the phone. Maybe we'll jump on a Zoom with the other guys, and that turns into kind of our own little private lender informal committee to make a decision on something that might be a little bit outside the box or just a little bit larger. But that's very similar.
Yeah, and also to sum some of this stuff up is, you're right. Like, and going to what Scott said, it's like, hey, someone's just calling and for the rate, and that's fine. And like, people ask the rate because they don't know what else questions to ask, right? Like, that might not be the most important thing, but I get that all the time, and I'm like, sure, can you tell me a little bit about your project? So it doesn't have to be a long process, but in general, like, we don't know you, you don't know us. Like, I don't want to, judge you by, judge the book by the cover, by you just saying, oh, what's your rate, and me giving you the rate, and that works. Like, you need to do a needs analysis on both sides, right? So, like, for instance, if I call Scott and he's like, oh, I'll give you a 1% interest rate, and like, that's all the due diligence I do on Scott, shame on me, because all of a sudden he might not even have the capital to do the deal, and then we can't close. And what does it matter what the rate is if you can't close anyways? On the other side, someone might call me and say, hey, you're a 13% interest rate, I'm not interested, I'm looking for 11% or whatever for a private lender type of thing. And they hang up on me. And on the other side, maybe they go with someone with a cheaper rate, then they can't close the deal. So it's important for both sides to ask a lot of questions. And again, this isn't like this super detailed, like, college presentation you have to create. Like, let's have a 5-minute conversation to figure it out. Like, and unfortunately, a lot of people just, might not know what to ask, or vice versa. But you gotta, we look at the 4 C's of stuff, so of underwriting. So we're looking at collateral, we're looking at character, right? Character is more important to us than capacity and credit score on things. Credit's the least important, right? On things, but we still look at everything in general. If someone cannot execute on a project, it doesn't matter really how much cash they have. Like, if we don't believe that they're able to accomplish this project, I mean, right now, it's hard to find really, really good opportunities. There's a lot of loans that we look at that somebody's buying a property for $150,000 and needs $50,000 in work, and it could only be worth $200,000, and it might not necessarily work. So I got to have conversations with them to explain that with them. And again, I'm not saying that we all totally agree on value. We all agree on the same things. You can have disagreement. Someone might think it's worth 200. We might think it's worth 180, but we got to have a open, candid conversation. And again, it's a 5-minute conversation and that's it. So I think if you're a newer real estate investor or an experienced real estate investor looking for additional capital sources, spend the extra time, interview the lender like the lender's interviewing you, underwrite them as well. Make sure it's a bank that you believe if they tell you they're going to do the deal, they're going to do the deal. If it's a private lender, you're going to do the deal. I mean, I know this might sound crazy for people, but like almost half of the loans that we do are because some other lender underquoted somebody and told them they could lend more than they really could. And the deal fell apart and they had to come to us with 2 days left and we ended up closing. We do, out of our 20 loans a month, 10 of those are like that, right? I tell somebody transparently, like, hey, we're going to lend you like 130. These are going to be the terms. And they go find someone that can give them 120, right? $10,000 less with a 10 or 11% rate instead of a 13% rate. But then they can't close it, right? So now they're coming all the way back after they spent money on this and they wasted 30 or 45 days. So again, you gotta look at everything kind of in general, and then you make the best decision of what works best for you. I mean, we're underwriting a borrower. The borrower should be underwriting us.
Right.
Same thing.
Yeah. I think one good point while we're on this topic to understand is, like, sometimes it seems like there's that adversarial part, right? Oh, what's your rate? And you're like, well, tell me about the deal a little bit more. And I view it, whether it's hard money, private money, or banks, we're partners in this deal. It's a partnership, and it's important to understand that. And it's also important to understand that as the lender, whether it's hard money, private money, or bank, we're bringing 70 to 80% of the money to the deal. So there's certain things that we're going to want to know to get comfortable in that partnership, whether it's a relationship and partnership, like just like your wife. There's certain things you're gonna have to bring to the table in those sorts of situations. I think it's the same here, and a lot of times it gets kind of misconstrued of like there's this adversarial thing. Some of those old commercials on TV, you're on one side of the desk and the customer's like, deny. It's not that way. We're looking to form these partnerships.
Yeah, and that's actually somewhere where I wanted to go with. I was going to ask Redmond because I know, Scott, we talked about this too. We keep talking about relationship and the difference between like hard money bankers. We don't have to make a banking deposit there. Red, what does it look like? Like, what's the importance of the banking deposit relationship when a borrower is coming to you? Maybe not on the first loan, but you start doing a few $1,000,000 on loans. Like, why is that important? Like, how does that build that relationship long term?
So I think exactly what you're saying, Ian. I mean, it's building a relationship, right? While loans are great and good, deposits, are just as good. And what we like to see is just the ability to show that, hey, I did the loan for you a year ago. We're about to do another one. Why don't you move some deposits over? Because it makes the entire relationship look better. Because when banks look at it, they're looking at everything, right? They're looking at whether you have, cash management stuff like the check scanners, etc., your deposit amounts, your loan amounts. They look at everything. So the more stuff that you have with somebody, the better the relationship is. Also, that relationship shows whether it's, me, Chris, or Scott going to that next level up to get something approved. Hey, fun fact, Ian has $1 million in loans, but he also has $100K in deposits with us. It shows that you're trying to build something with us and for yourself.
Yeah, and I can attest to that because we have banking relationships as well. And I don't want to say you get like special treatment, but you grow the portfolio and you grow the relationship with them, right? Like you may do a deal, then you put one of your deposit accounts with them, and then you grow and grow, and then it makes it easy. I mean, listen, I think we can all attest that, if you're looking to close on a property really quickly, you don't have a banking relationship yet, like that's probably not going to be the best option overnight. But if you are a real estate investor and you're either looking to expand or you're looking to potentially start and grow, start now, right? Be like, hey, listen, let's figure out kind of what your requirements are. I have a checking account, I have whatever, a account that we can start the relationship with, and you grow with it. I mean, it doesn't, none of us started with like, oh, hey, here's $2 million. Like we all started from scratch, right? And you start, and then you work your way up. There's a bunch of really good questions that came in, so I want to go through these. Aaron's the non-recourse one will be. We can go through that quick. I'll just pop that up just so everyone can see the question, and you guys can get to that in a sec. Any recommendations on non-recourse loans? So pretty much a non-recourse loan is just a loan without a personal guarantee on it. But let's start with this one to switch. What do you guys look for the borrower on a multifamily or maybe self-storage or a warehouse compared to a single family? I mean, Aaron, if you don't know Aaron, I mean he owns a lot of rental properties, single family rental properties, a few multis and some other unique types of projects as well. So he's always looking for kind of creative financing, and he's got cash and skin that he can put in some of these deals as well.
I mean, I'll start it off. I kind of think that it's all the same. It's just the scale, right? So a single family house is, let's say it's 150. Then you go to multifamily for $1 million. You buy a warehouse for $2 million. I mean, I think it's all the same. It's just the scale. So, I mean, it doesn't really change anything for me if you're working with the same mentality on a single family house as a multifamily, as a self-storage or warehouse. I think you have the right idea.
Yeah, I agree with that. I think it's just it's all scalability. Like, look, you can have a guy come to you to buy a warehouse. He doesn't own any sort of property, but he's buying the warehouse to run his business out of, and it's a multi-million-dollar a year business. I mean, it's that's not going to have an impact. I know Aaron's questions come from the investment side of things, and I don't think we're going to look at it as what's he bringing to the table, what's his strengths. Doesn't necessarily have to have prior experience, but we're going to look at the whole picture and hey, does the deal make sense?
Yeah. Do you guys know any non-recourse lenders? Do you guys have a non-recourse product? I mean, I could pass this to Chris, or I could just answer it real quick myself. But like, as hard money bankers, we will do a non-recourse loan because, as far as we're concerned, we'd rather a reduced LTV than have a personal guarantee that potentially could be hard to collect on anyways. So what we do is we typically will lend up to 65 LTV with a regular guarantee, or we reduce our loan amount or LTV to 50% with no personal guarantee. And that actually has played well for anybody who buys properties in a self-directed IRA, because you can't personally guarantee it because the self-directed IRA is the purchaser or the buyer. So we do lots of loans for real estate investors that, let's say they buy a property for $200,000, they have $100 in their IRA, in their self-directed IRA, we'll give them another $100 and to buy the property, to buy the rental property, however it's set up, without a personal guarantee. So do you guys have a no recourse product at the right numbers?
We do not at this time. I think some banks do. I don't know what Red's bank is doing, but all that if it's a multifamily space, a lot of the agency, Fannie and Freddie's, all non-recourse. And then outside of maybe what banks may or may not do, I know a lot of the commercial mortgage-backed securities markets, they're all typically non-recourse, or life insurance companies. But I'm not sure what other banks are doing non-recourse wise.
How about your draw product?
Yeah, we'll do non-recourse. However, lower LTV, higher DSCR, and it's usually for a larger deal. So, but
you're talking $1 million plus, right?
Yeah.
Yeah, that's usually where you start to see the non-recourse debt come in, about $1 million, $1 million plus. We've been going for about an hour. There are a few really good questions on here, and Jay, if you could pop up McLean's question. What's a good way for a newbie to introduce themselves? There is this, I know, kind of like this gap between like the borrowers and commercial banks, or the borrowers and hard money lenders. Like, what do you guys like to see? Like, if they're shopping, or they just want to understand the product, what's the best way they can introduce themselves and find out what's going out on the marketplace? Chris, you want to start?
Yeah, sure. So a couple answers to that. So there's absolutely nothing wrong with reaching out by email and trying to get a hold of one of the originator underwriters at HNB and maybe schedule a quick call. Just say, hey, I'm looking at this. I'm looking at that. How does it work? That is the right way to reach out. That being said, we do deal, just being, transparent about this whole thing. Our team deals with dozens of leads each day. And oftentimes the priorities are going to go to properties that are under contract and repeat clients, and that's just like the reality of it. So I say that because if you don't get an immediate email or call back from a hard money lender, it's not because they don't like you. It's because they're freaking busy. And they'll circle back. But no, having that conversation, just going in about here's what it looks like, the kind of skin you're going to need. Here's good places to buy, places we would stay away from, and just having like a quick conversation just to hit the main bullet points of how the lending and buying process works.
Yeah, how about you, Red? What's a good way for borrowers to get a hold of you guys or find out what's going on with your bank?
Yeah, I agree with Chris on the email, man. Just shoot me an email, introduce yourself, kind of I guess give me a general idea of what you're looking for, and obviously we can connect.
Yeah, yeah. Scott, what about you? Is there a good way to find you guys? Because I think something else that comes out of all this is that if they don't have a product that works or you don't have a product that works, I've seen you pass us and say, hey, this doesn't fit our mold. I know so-and-so at this bank. Like, I think that's part of this conversation is what works well for people, right?
Absolutely. And similar to what Chris and Red said, just send an email, letting me know that you want to, schedule a time to have a conversation and discuss where they're at, where they want to go. And I spoke about this earlier. Just be prepared to tell us like where you're at, what you want to do. I do get a lot of calls sometimes where people like, yeah, I want to do this, and I don't know if I want to flip this property or keep it as a rental. And I think you got to really, there's going to come a point in time where the rubber meets the road, as I say. You got to figure that out. Is it a rental or is it a flip? Because you start to go off, the road divides there, and you got to make a choice. And it may not work well as a rental, and it may only be a flip, and vice versa, sort of type thing.
Yeah, and I think a big thing to realize is, if you're a newer real estate investor, you kind of have to push all in, just like everyone had to at the beginning, and learn, right? You learn, you network, you talk to people, you watch videos, you potentially buy courses, read books, and things like that. I mean, I talk to so many people every day, and like they don't know what they want. They don't know what they want, and they haven't educated themselves. I mean, imagine if you had like a private lender that lived next door to you that had $100,000 and you wanted to partner with him. They're not going to partner with you if you don't even know the business. You're supposed to be, and I don't want to say an expert or experienced, but you have to do the heavy lifting yourself. I mean, if you reach out to somebody asking for help or asking for advice of their particular niche or their product, and you don't have your ducks in a row of what you want or what resources you have, you're capable of, it's going to be hard for them to do it. And not that you lose credibility, but like that's the case. I mean, I have a lot of people that call and say, hey, I want 100% financing. I don't have any money. I don't know what I'm doing. I don't know if I'm going to flip or I'm going to rental, but this is a good real estate market right now and I want in. And, unfortunately that's a little bit unprepared. It's a little bit unprofessional. Do it the right way. I mean, between DC and Baltimore, these are high property values, right? You're asking for a lot of money in general. So you got to be professional. I mean, I remember when we started out in the early 2000s, we started Hard Money Bankers in 2007, but in the early 2000s when we went, we raised private capital. We used banks. We had Hard Money Banker. We had other hard money companies that we went after. But like, we were prepared, right? Like we spent money on courses, we read books. They didn't have YouTube back then, but we educated ourselves as much as possible related to it. So we knew what was up, right? Like Scott's not your real estate mentor. Red's not your real estate mentor. Chris isn't your real estate coach, right? He's a partner, right? You have lenders, you have contractors, you have other vendors, you have real estate agents. They're all partners, right? On these things, right? They're not. I don't want to say that they can't help you, but and they will help you, but it's not their necessarily job to start from scratch on this. If you don't know, just like any goal setting, right? You start with the end in mind and you work backwards. If you don't know if you're going to fix it, if you're going to flip a house or rent a house, you got to figure that out. Yeah, your goal might change, right? You might have thought it was going to be a flip, and then you're like, you know what? This doesn't need as much work as I think. I've got a tenant that want to move in. That's all fine. Those are all good things. But you need to you need to have your action plan set up ahead of time. And again, it's okay that you don't know some of these things and naive about things. I mean, like, we've done a lot of residential stuff, but we haven't bought that many commercial properties, right? But that's okay, right? I'm educating myself on that type of stuff, and potentially I call Red or Scott and say, hey, listen, hey, I'm looking to buy some commercial properties. I understand the industry average is I'll be 25% down. I have that available type of situation, right? Like, damn well if somebody calls any of you guys and they say, hey, I need 100% finance, I don't have any cash, I don't know what I'm doing, there's just not much you can necessarily do. And a lot of the times that doesn't mean, like, unfortunately, that's just the nature of it. And there's a lot better professional ways to do that. Another way you could say it is say, hey, listen, I'm looking to get into this business. I have a W-2 job right now that I really, really like. I want to keep it, and I want to do this as a side business. I'm curious, how much, I've been saving some money. I've got some friends and family that want to invest in these deals with me side by side. How much approximately do I need? What do your terms look like? That's just a better phrase. Like, instead of like me telling you what I need you to do for me, it's like, hey, how can we work together, and how can we structure a deal to make work?
Yeah, Jason, that's an excellent point. And I think that gentleman, I think it was Mike, that sent that comment and that was thanking me for walking him through the lending process. What you just said is exactly what he did. Hey, man, this is where I'm at. He laid it all out and kind of like gave the basics of a roadmap. Now it's just like help him navigate the twist and the turn. So excellent point, and shout out to Mike for kind of making it easy for me and laying it out that way.
Yeah, I mean, we all want to help everybody that we can, but it's got to be
absolutely.
And there's so many like good potential real estate investors that I talk to on a regular basis, me personally, and I believe you guys do as well, that like I really want to help them, but they're just not fully ready yet, right? Like, they haven't found a good enough deal yet, or they don't have enough capital yet, or they're just not fully there. They haven't got their whole team yet, but they will be, and that's okay. And I mean, a question that you guys probably get as well is, do you work with first-time investors? Because I get that question a lot, and I think because a lot of the national private capital guys or national hard money lenders don't, like, you need to have a certain amount of deals. I love working with first-time real estate investors, and typically the ones that I see are the most successful, who have good jobs already, and they're trying to get out of potentially that rat race and add real estate investing to their arsenal. And by doing that, like, they're hungry, they're motivated, they're willing to put up, as much harder in cash as they can, and they don't want to fail, right? Like, I worked hard for this cash. Now I'm going to use it to invest. I love it. Deals like that, they really never default. A lot of these first-time clients that are really passionate about this, they put in the hard work, they spent time or money with some sort of guru or mentor or coach to help them. We really rarely ever have issues with them because, they're putting a lot on the line and they're committed to it. And I'm assuming you guys probably see something similar.
Yeah, they're definitely all good points. And the thing is, I think having lenders go last by pure accident was that you guys tie it all together and reiterate all the points of what the real estate investors are looking on the front side of. I need to underwrite my deal right. I need to do this. I need to do that. And it's not just because they want the deal to work. It's because they need the lenders to work. They need the private capital to work. They need this whole thing to work as one. And you guys kind of bring it all together. With that being said, guys, REI Madness has been a blast this week. I was telling these guys earlier, I was tired. It's been a lot of work. It's been awesome. But if you found any value in this, check out reimadness.com. We're raising money for the Metro Burn Foundation. We just had a few other donations come in. Scott Spear, I want to give you a shout out. Thank you for your donation. With that being said, Scott, Chris, Redmond, how can we find you on the internet or get a hold of you guys? Scott, you want to go first?
Sure. Our company website is easternsavingsbank.com, and you'll be able to find all my information there. You can reach out to me. My email is my first initial S, my last name, Freitag, Freitag at easternsavingsbank.com is a great way to get a hold of me. I am on social media, so you can look me up there. LinkedIn, Facebook, those two. I'm not a big Instagram guy, and I certainly don't. What's that, TikTok? I don't do any of that stuff.
we heard Vadim was the only one dancing on TikTok last night. At least that's what I don't remember who called you out, Vadim, on that, but that was funny.
Chris, where do we find you? I think we all know the answer, but
yeah, reach out, check us out, hardmoneybankers.com, at any social media at hardmoneybankers, or feel free to email me personally, chris@hardmoneybankers.com. And yeah, just thanks for having us on. Very, very cool event. I appreciate it. REImadness.com. Throw out a donation or two.
And Red, where do we find you?
Yep, just shoot me an email, redmond.beam@shoreunitedbank.com. You can find me on LinkedIn, and then these guys are going to post something up too that'll have all of our contact info. So thanks a lot, gents.
Yeah, thanks, guys. We appreciate it. If you currently, however you're watching this right now, it's on multiple Facebook pages and groups and some LinkedIn channels and some YouTube channels. That's the replay link. A lot of people have asked us for replays. These are all live streams, but they're evergreen, so they'll stay there and they'll stream. One last shout out from Nick. Hey, Nick, I appreciate it. I'm glad you watched all these REI Madnesses this week, and we provide value. And like we chatted a few days ago on this, HMB is coming to South Carolina soon, so hopefully we'll be able to help you out with some of these deals.
Yeah,
hi guys.
And one last shout out to Ian and Jason. Can't thank you guys enough for what you do, not only for the whole real estate community, but this. I know this wasn't this, and just so everybody understands, you just didn't wing this and throw this together in 10 minutes. So a lot of work and time and planning went into it, and it's greatly appreciated. And hopefully everybody that's watched or sees this later understands that and hit these guys up with all their knowledge and get to utilize some of the resources.
Jason, get me out of here before I shed a tear. Appreciate it. Yeah.
Thanks, guys.
See you guys.
Thanks.